Welcome to Compound Insights, a podcast by CFA Society New York. I'm Rob Rowan, your host. Today we're talking with David Knudsen, CFA, who is head of credit of the Americas for Schroders. He and I talk about the credit issues around U.S. banks and the global bond market. So, David, we have had a really interesting amount, I'll call it an interesting amount, of volatility in the markets in the last few weeks. Some of the leaders have gone to laggards, laggards have gone to leaders. We've had Seven Sigma events, and where we are in the cycle has also raised the uncertainty for many CFA New York members. Many of them have been talking about looking at the performance of financials, particularly banks at this point, to be able to understand that risk. What do you see in the financials of this moment?
Well, it's been a tale of two markets. The equity markets have absolutely gotten axe murdered. I think there's a few other words to describe what have happened to the banks, particularly the smaller banks. They have sold off very, very hard, and they've sold off based on the shape of the curve, slowing economy, the specter of rising credit losses. You could even argue maybe expectation for increased regulation in a future executive office or a change in the executive office. The credit markets, the markets that I really focus on, have actually held in pretty well. And when you think about the big banks and even the regional banks that issue public debt, they've moved broadly with the market, but they have been generally rock solid. And I think there's a couple reasons behind that. One is there is very limited supply. Banks simply, and the economy's not growing, banks are not requiring additional funds, and so they are not pumping the market with more and more issuance. Most of them have easily met all of their bail-in capital requirements. They've met their liquidity requirements, and so they're comfortable from a funding access or funding perspective. The other thing is there's no signs of weakness in the next 3 months or even some farther out-looking factors or signals as far as asset quality. Capital is better than it's been in my entire career for the last 20 years, and liquidity is actually at levels that are unheard of. In fact, liquidity, I would argue, has contributed to some of the most recent volatility.
Mm-hmm. Yeah. Can we take a quick step back and talk about the fundamentals that you see for the sector? I presume that's based on their, let's face it, the global macroeconomic scene is pretty strong. The U.S. macroeconomic scene is pretty strong too. Is it that, or are there other factors that you're seeing here?
So I think the generally speaking, banks have had they had a moment of reckoning with the global financial crisis. Regulation went from principled to prescriptive, and that might be a subtle change, but to a bank analyst, what that means is that pre-crisis banks were kind of left to regulate themselves almost. It was a lighter touch regulation, and that eventually provoked this kind of seeking a lower common denominator. Every new and riskier idea that came into a bank was initially, considered, too risky, but then tried out and it turned out okay. And so it was embraced and it became mainstream. And then they found something else even more risky. The global financial crisis put an end to all that. They created rules that were kind of one size fits all, and they sacrificed a decade or more of economic growth for the safety of the financial system.
Mm-hmm.
And as a credit analyst, I benefited, or our market benefited from that. And banks are still, I think, underrated. They're still probably the most secure part and safest part of the credit spectrum.
Mm-hmm. Yeah, speaking as a former analyst, I know that regulation was met with some consternation, but also in the seat I used to sit in, one where we said, our bets are getting a little bit less risky now. So, how do you see the intercedence of NBFIs into the market evolving going forward? I mean, they came in, they've occupied some segments quite well, but they kind of stopped there. I wonder where you see them going from here.
So I think they have an important role to play in any market. A non-bank financial institution is is an entity that addresses a need. I'm a firm believer that access to credit is almost a fundamental right. It's something that it helps to smooth out the bumps in life, and the reality is that some parts of society need access that is not traditional, and the non-bank financials offer that access now. Some of them offer it to consumers. That's maybe you have some of the short-term loan companies, check cashing companies, or those kinds of companies. And you also have non-bank financials that offer it to small businesses. And generally, the underwriting, and once again, it's all a cycle. Initially, post-crisis, there was very little credit available. There was a big demand. It attracted some private money, private capital, and the underwriting was robust. And then from there, I think things have grown significantly. And frankly, I think some of the underwriting has become weak. And I think when you look to where a potential problem could develop, I think you could find it in that segment of the economy.
So I have seen some reports which put some of that underwriting risk on auto loans, particularly subprime. Although that has been going on for a while. People have been saying that for some time, and there has not been a big blow up there. Do you see it there? Other subsectors of lending?
So subprime auto is really it's a segment of a segment of a segment. So it's hard to see subprime becoming a systemic problem. It will, and a lot of the capital in that market is still private capital. So I don't see it rising to the point where it's going to impair the system as a whole, or even really meaningfully impact the overall economic growth of the country. But subprime auto is a challenging. You do see loss rates increasing in that part of the credit spectrum. You see subprime cards. So if you look, there's an interesting statistic. If you look at the top 100 banks and their card programs, which is by far the vast majority of all the card programs. In fact, the top 6 banks really
are 95%.
95%, yeah, and another 85, and you'll get another 4%.
Right.
However, if you look at the next 100, and these are smaller banks, regional banks, and they have some small card programs, some of their loss statistics are hockey sticking.
Okay.
And so some people are saying, well, this is a harbinger. This is something we need to focus on. This is an early warning. This is the canary in the coal mine. I tend to disagree with them. I think that it is such a small part of the market, and it is often so closely tied to maybe a specific economic zone or region of the country or industry. So maybe it's some part of a state that's focused on farming, for example.
Right.
Okay, and maybe maybe they provide credit to that area, and frankly, farming has been tough the last 6 months to a year, and yeah, their credit card rates are loss rates are increasing significantly. But I don't think that describes the average consumer. I think the consumer is very strong now.
How about C&I? Where do you see that right now?
So C&I is when you look at overall loan growth is doing better this year than it has the last couple of years. C&I started out the year like it was on a trajectory to do better as well, and it's kind of tailed off in the last 2 or 3 months. Consumer, on the other hand, continues to power along relative to the last 5 years. But C&I has kind of slowed a little bit. It's still running above where it has the prior 2 years, but C&I usually runs kind of in that mid-single digit. It's running in kind of the low single digit in terms of growth. In terms of underwriting and asset quality, C&I and consumer, in fact, most of the broad asset quality metrics are half of their long run averages. So they could deteriorate significantly before we'd even start to consider it an issue for most banks.
Switching back to financials for a moment, do you think that there are other risks that are not so esoteric that are facing the smaller end of the banking industry? So, because you mentioned some of them are local, some of them based on concentration in a particular industry. Are there other issues that they are facing within the larger context?
Yeah, I think we've finally reached an equilibrium in terms of returns. I think that um, that the banking system is in balance, and it's taken a long time to get here post crisis, but creditors enjoyed a lion's share of the benefits post crisis, where equity providers of equity capital were given less than expected returns, and so we've got a balance now. So what can throw this out of balance and sow the seeds is usually starts with incremental risk taking, and that is people look at the senior loan officer survey, or they look at some of the consumer higher volatility assets, and they credit card underwriting or stuff like that. I I, I think those traditional metrics are not there. And so, if you want to really start to imagine where it can come from, if you have a slow and steady state, people run out of traditional ways to outperform each other. And I'm going to point to some European banks now, in that if you can't earn a balanced rate, then you end up taking shortcuts. And shortcuts often look okay initially, but then they lead to mis-selling, whether it's here in the United States with Wells Fargo, quite frankly, or it leads to anti-money laundering with some of the Scandinavian banks. And I think that is where you have to be a little more prudent. I think the other thing is that there's banks are looking further into emerging markets. And some have been there a long time, and they've gotten used to the risks, and they're fully appreciate what they're getting into. And some are new entrants. But the bottom line is, after a period of benign outcomes, people generally feel less feel more comfortable with risk. And I would argue that when you're banking in the emerging markets, I think there's probably some underappreciated volatility.
Okay, so I hear you saying that the recovery from the recession was good for the big banks. So was some of the regulation as well, because it made their asset quality higher.
Mhm.
Sounds like most of the risks are relatively remote. So, one of the things I like to recycle every once in a while is, what could go wrong with the forecast? what what are the things that keep you up night?
So, one of the things that keep me up at night is, like I think we were talking a little bit before, the front end of the curve is dislocated. And because that doesn't sound very scary, most people nod and smile politely and wonder really what I just said. But the reality is, the front end of the curve is where you see the signal, generally speaking, of a banking crisis. And so when the repo trader or the short end person here at Schroders comes to me and says, repo, GC collateral just hit 8%, I get goosebumps,
Right.
because in my career that's only happened a couple of times. It happened Lehman, and it happened a few other moments like that. And so I immediately want to know what the heck is going on. So I think the front end of the curve is dislocated, and what is going on is you have too many sellers and not enough buyers. That's the classic.
Right. But we've had these types of things happen before. And one of the things that I think is difficult about forecasting is sometimes you see yield curve inversion. And the yield curve has flirted with inversion a couple of times. It has actually gone inverted a couple of times. How do investors, in your opinion, view these types of events and then translate them into an asset strategy?
So it's hard to deny that yield curve inversion has a pretty good record of predicting a recession. But I think that we are in unusual times. We are in uncharted territory, and it may play out. But in our business, it's not only telling me what will happen, but when it will happen that you make money with. And I think what is people don't fully appreciate is the willingness, not only of the United States, but almost every developed country in the world, to race to the bottom, to debase their currency, damn the torpedoes, spend as much money as you can, drop it from helicopters, and if that doesn't work, build bridges to nowhere.
Right,
And that's the
drop
next
more.
step. Drop more.
Right.
Yeah.
Yeah, I noticed that Slovenia went negative yielding on Monday.
Yeah.
That's a
Slovenia.
single A credit.
Yeah. I mean, there's something very wrong about that. I mean, not that there's anything against Slovenia, but, there's been hundreds of years where people have earned a risk premium for lending, taking risk.
Right.
I think it's implied in that comment I just said. And there's also been, for the most part of the last couple hundred years, the longer you lent money, the more risk premium you received.
Right.
Because future is uncertain.
Right.
And you add up uncertainty, and that returns a higher return. But what's gone on now is you've got, 40% of the market trading at a negative yield. And, a lot of it is attributable to a couple of places. Japan is, there. But as you just mentioned, Slovenia, you talk about Germany, you talk about some other European countries, not only is the government yield negative, but you're seeing corporates print negative yields. And that is that's a hard thing for people to get their heads around.
Yeah, I think the market was, generally speaking, comfortable with it when it was, Japan's been for a long time. But Germany was one thing, but I think we heard a gonging sound when the Czech Republic went negative.
Yeah.
And another gong when Slovenia went negative. So I think those are the tricky parts of it.
Yeah, and it's surprising how quickly greed overcame fear when it came to Argentina. And then it's surprising how quickly fear overcame greed.
Right.
Within a week, those bonds had dropped 40 points.
Right.
So I think, when you think about opportunities, those are great opportunities, because if you've got a fundamental research shop and you've got a fundamental view, then we are waiting with capital ready to deploy when the market overshoots. Because the reality is it's hard to buy it's hard to accumulate a meaningful position when you're going with the market. Right. It's very illiquid. The costs are tremendous nowadays. But so really you have two opportunities. You can do it in primary, which you fight with everyone else for the primary allocation, or you have to have a value approach, and a value approach that is high conviction based on fundamentals, and you can buy as much as you want in Argentina nowadays.
Right.
Whereas a month ago it was hard to really get execution. I think what you're going to probably see happen is you're going to see a vintage of, I'm going to call them recession babies, but they're not babies. They're the management teams of the global banks. They're going to mature and retire in the next 5 years. And I'm talking everyone from the Jamie Dimons to everyone that went through the crisis. And I think, I think we're pretty safe now, because we're still under this kind of overhang of, I remember how bad it was. Right. But there will be a new crop of managers that come in. I think that is probably one of the underappreciated risks. It is a longer term risk. It isn't something that is going to happen immediately, but I think memories are short, and there's this constant battle between fear and greed, and fear is receding. There has been a benign environment, and that usually provokes incremental risk-taking. And initially, the pennies that you're picking up in front of the train or the steamroller or whatever you want to, there's no problem. And so you reach ever closer to that crushing wheel or the tracks, and eventually that will be the problem. I think people will, you'll see the older generation generally retire or be considered that they don't understand the new way of making money. And that is when you better keep your hand over your wallet.
Right. Watch out for the new products, folks.
Exactly.
Yeah.
You know, one of the things that I constantly am on the lookout for is I use the term disruption because that can, I have a sad story about investing in a taxi company in Chicago about 10 years ago, and it did not turn out very well, and it's because of disruption.
Right.
But there is a small voice in my head that worries a lot. It tells me to worry a lot about financial technology or fintech and how it could disrupt some of these models. And the bigger voice says, you know what, technology company doesn't want to get regulated the way a bank is regulated. They don't want to open up their code. They don't want to have the oversight. They don't want to be hauled in front of Congress. They don't want to. But I do see a system that continues to earn what I think is generous returns. And I'm speaking financial services in general. And I see a relatively low use of technology. And I see a lot of archaic methods and procedures and processes. And I also see how, far the U.S. is behind. The U.S. is behind. When you think of the United States, you often think that, well, we're a first world country. We've got beautiful buildings and cars and electronic and all this good.
We got Facebook and Google. And
But you know what? You go to some African countries, and the way that they transfer value, the way that they make payments, is so much more sophisticated than the United States. I was in China, and the person I was traveling with did not have any cash, paid for everything with electronic, with his phone. And I feel like I came back to this country, and I felt like I needed to maybe go out to the outhouse with a Sears catalog because we were 50 years behind.
Well, coincidentally, I got an email from my bank yesterday telling me that my next credit card will be contactless.
Yeah.
And if you've been to the rest of the developed world, that's from like 9 years ago.
Yes. So there's disruptions coming along, and only by the grace of, maybe a strong lobby have some of this been held, or the fear of over-regulation. But it'll come first in the form of payments. That is the one that will be taken away from the financial services industry. The credit and the underwriting, that's trickier. But and there's still a human element, I think, needed in that area. But it's unreasonable that and the costs are so high to borrow money and to lend money, whether you're buying a house or factoring a receivable or getting a loan to build a business. It's there's way too much margin there, and when you look at what technology has done to other areas, be it retail or be it to warehouses or other parts of the economy, it's just surprising that finance has so far been able to stay to not let that in.
Mm-hmm. On that line, do you think that there is a risk of the overindulgence of fintech on modeling?
Yeah. I think there's always this. I call it a fetish because people see these beautiful predictions and they can kind of make you feel comfortable that the computer understands. But what the computer or what technology has yet to really fully appreciate or to model out, even AI, is fear. Right. Fear is a distinct human emotion, and fear and the opposite of fear is greed, obviously. Those two things are really, really hard to model because they don't move linearly. Right. And you don't really fully appreciate fear until you are trying to decide whether or not you're going to lend to someone short-term collateralized. Right. And then you decide you're not going to, and then the next day that institution's dead. And that's typically what happens to financial. over, the regulatory relief that's going on, I don't fear that. I do fear that if I do think that the biggest bubble in the world is government securities, and I don't know how or when that will pop and who will be caught holding the bag, but that is going to be the mother of all messes. And you can look in the past, you have to go back, a couple hundred years in different times, different countries, but it's happened before, and it's no different than tulips or tech stocks or houses. It will pop, and there will be losers. My sense is that that it'll probably be met with, you'll have a wholesale change in the financial structure of most of the developed world. So the other potential change or the risk I see is that it seems like we've finally crested this period of finance and banks are evil. And I really think at the end of the day, the social purpose of a financial institution is no different than a farmer. It's to find the best place to plant the seeds, in this case, capital. It's to grow the best crop, to harvest it, and to return seeds that they borrowed to the depositor, and distribute the rest to their shareholders. That is a fundamental social purpose, and by making that difficult or continually hammering the banks for political reasons, I think is potentially problematic, because the next step after you deem all financials bad is to direct lending. And that is when you say, well, you would be better if you lent here or lent to that person. And that always ends in a mess.
So you said you believe that has plateaued. Is that because it has been less common in the political discussion of our current time?
Yes, in our current time, but my concern is that politics evolve, and I think there's still a lot of, when you look at how Main Street has fared and how Wall Street has fared, and how the recovery has been uneven. I think it's easy to, when people are looking for a segment of, or a part of the economy that has done better. Financial services have generally done better than manufacturing. Let's just use those examples. And I think it becomes an easy target for populism. And it doesn't have to be in the United States. It can be anywhere in the world. And this idea that, whether it's increased regulation or directed lending or limited business, those things, initially look and sound good, but ultimately they sow the seeds of bigger problems down the road. So QE and all the other things that have done, the governments have done post the global financial crisis, have been to stimulate inflation. They want to increase asset prices. And why do you do that? Because there's really only three ways to discharge debt. You can pay it off, which most people do. You can default, which some people do, and you can inflate your way out of it, which some people do too. Some countries do. And generally, people feel the easiest way is a little bit of all three, mostly just paying it off and inflating it, because that you kind of get the benefits of giving the money back, but you don't have to pay quite as much because inflation gives you greater future earnings relative to your debt stack. This has really run its course. I think that the negative rates or unlimited bond purchases or quantitative easing, I think has initially, it served its purpose, but it has run its course. It is, every initial dollar is not, that's spent, or pound or euro or whatever, is not going to provoke the kind of initial response it did back in the 2013, 14. And I think the kind of the way I look at it, it's like pumping a patient with more and more adrenaline. Like the first couple of shots, it really, it's going to help the patient, but you keep doing it, it's actually going to become harmful. The next phase will be fiscal. But where are the people that are talking about the amount of debt that the United States is accumulating? We're talking about debt that was, close to zero when my dad was born, right? It's, projected to go to 140% by over the next couple of years at the current spend rate. And part of it is the monetary stimulus, but part of it is the beginning of this fiscal stage. Right. It's going to get more and more and more, and ultimately, I think it'll probably fail too. I think it's a broader dynamic that's driven by demographics, and it's also driven by a leveling out of the emerging and developed worlds.
I hope you enjoyed our podcast. If you have not yet, please subscribe at the podcast app of your choice. Also, please visit us on the web at cfany.org.